Now let us discuss cash and cash equivalents in much more detail. Cash and cash equivalents, as we have discussed earlier, are the part of the current assets. And if you look at cash, cash is actually required for day-to-day operations of the business. The company may have to pay salaries or pay bills in order to survive on a daily basis. So they cannot run to the bank in order to kind of withdraw money and pay basic salaries or bills. So essentially they must have basic amount of cash in hand, and there are various ways in which the cash can be kept in the company. It can be, as I said, in paper money. It can be kept in checking deposits. You can also have undeposited receipts. I mean, an example of this could be that the company may have given some initial deposits as a part of the lending agreement. So these deposits may also be considered as cash, and money orders, of course. So this liquid cash is very important from the point of view of liquidity of the company. The other term, which is called as cash equivalent, is equally important because many a times, let's say when the company has excess cash, a lot of cash in the bank balance, they may not want to kind of just keep it without earning any interest on it, because normally checking deposits don't provide interest income on that. So what companies or businesses normally do is they invest in very less risky and liquid securities which has an ability of generating income. So example of cash equivalent which can lead to generating income with low risk is commercial papers, or maybe treasury securities, money market funds, and bank certificates of deposits. All of these are very liquid and can be withdrawn at any given point of time. So both of these are considered to be a part of the current assets. So as we have understood regarding cash, cash is basically used to finance the day-to-day operations of the business. However, you may find that there are many companies that store large amount of cash as a percentage of total assets. Ideally, it should be a smaller portion, just sufficient enough to meet the operations smoothly. However, we may face a situation where we should ask ourselves that why should a firm hold large amount of cash? So we tried to investigate and found there were three reasons associated with it. The first one was that the company is doing or undergoing a speculation exercise where they sense that there's a special opportunity that may come in the near future, and they just want to build the funds so that they can act very quickly when it requires. Number two is that the company actually wants to set up this fund as a precaution so that in case of any emergency, they would like to have enough cash in the system. Third one is basically related to transactions. There can be certain amount of cash outflows which are committed enough, and those amounts can be really large. So the company actually would like to pile up cash before the cash outflow date. So these are the three reasons why a company may like to kind of pile up large cash in the asset side.